day, everyone. Today we will introduce about the income statement. This financial statement is about summarize the profit for a specific period of times. Profit for a specific period of time. Those is important to understand a company, how can profitable and how we can analyze it. So this is the outline today. We will introduce the basic elemental like the net selling, this about cost and the other operating revenues. And then we talk about special income statement items. Basically, you have the five, six, seven items about it. And we will talk about earning per share and retired earnings. And finally, we will talk about something the dividends, comprehensive income, and how to compare with the IFRS. So this is our outline today. The income statement is often considered to be the most important financial statement. Frequently used title for this statement, including statement for the operatings, is statement of the income, and statement of the earnings. So both of the statement operations and statement of the income are very popular titles. Income statement is summarize the revenues, expenses, gain and loss, and the end with the net income for the specific period. A multiple-step income statement usually present separately the gross profit, operating income, income before income tax, and net income. Have two different simple or multiple step. So here is a very simplifying the multiple step income statement. May look like this one. We have the net income, or we call the revenues, the cost of goods sale, or we call the cost of sale. It's a negative terms, and we can show off this the gross profit and operating expenses or selling or administrative. It is also a next item. And also the plus item is the operating income. The other income or expense is maybe a plus or negative items here. The income before the income tax and tax of course, yes, the negative terms, and net income, and finally we got the earning per share. So the earning per share is very important items here, and also we have so many analyses or financial ratio is all around about the earning per share. We show the multiple step income in the previous page, and this slide show is the single step income statement, okay, which is total revenue and gain, and sale, other income, blah blah blah, and then detected total expenses and the losses, and the loss including cost of goods sales, operating expenses, and other expenses, blah blah blah. A simply single statement just look like your right hand side, revenue, net sale, other income, total revenues, group of the revenues, expensive, and the net income, and also we have the important things about earning per share. So it's also the difference, the multiple step and the single step. Here is the example for the single step. A single-step income statement lists all revenue and gain, usually in the order of amount, and then list all expenses and the losses, also usually the order in the amount. So totally expensive and the loss item deducted from the total revenue and the gain items determines the net income. Most firms that present a single-step income statement modify it in some way, such as presenting the federal income tax expenses as a separating item. For firm that have cost of goods sold, cost of good manufactured, and the cost of the service. Multiple step income statement should be used for analysis. The multiple step format provide intermediate profit figures usually in the analysis. And if you have textbook, you can find the uh, exhibit 4.1 is the single steps income statement, is the in case is the radio systems company. And also you can find the multiple step format income statement in the exhibits 4.2. It's a Intel coverage operations for the example. Net sales, or we call it revenues, is represent the revenue from the goods or service sold to customers. The firm earns revenues from the sale for its principal products. Sales are usually shown net of any discounts, returns, any allowances. Depending on the operations of the business, they may be other operating revenue, such as the uh, this revenue and the royalty. Okay? Cost of goods or sale, we can told you is about cost of sale. Okay? This category shows the cost sale to the produced revenues. For the retailing firm, different types of firm has the difference thinking about that. For the example about the retailing firm, the cost of goods sold equal the beginning inventory plus purchase minus ending inventory. But other side is the manufacturing firms or productions industry. The cost of the goods manufactured replace the purchase since the goods are producing rather than the purchase. But if your company is about the service like finance, bank, something, the service firms will not have cost of goods, sell, or cost of the sale, but it will often have a cost of the service. So if you have the different company, different industry, you provide the service, and depends on you provide the service or goods, you have a different category. Operating expenses consist of two types. One is selling, the other one is administrative. Okay, we talk the selling expensive first, resulting from the company's affiliated to the credit sale, including advertising sale, sale commissions, sale supplies usage, and so on. The second is about administrative expenses that's related to the general administrations of the company's operation. That including the office salaries, insurance, telephone, bed, day expensive, and other costs. It's difficult to allocate. In this category are the secondary activities of the firm that are not directly related to the operations. For example, if a manufacturing firm have the warehouse rented, these lease incomes would be other income, dividend and interest income, and the gain and loss from the sale of the assets are also including here. So interest expensive is categorized as other expensive. Special income statements items. To comprehend and analyze the profit, you need understanding income statement item that require special disclosure. So if you can observe it of exhibit 4.3 content item that requires special disclosure, These items are literated to the identified name for the discussion. But if you need careful, note that some of these items are present before text and then some are present net of text. So this one and the next slide is is a present about exhibit the 4.3. These illustrations of the special items. Income statement is a multiple state format, and if you look carefully about the your left hand side, you can see the A, B, C, D, E, F. There also is some the income statement, the special items, and we will introduce about these about 5 special items in the continuous slide. The first special item is the unusual or infrequent item disclosed separately. Uh, Certain income statement items are either unusual or occurred infrequently. They might, including such items as a gain on sale of the security, write-down of the receivables, or write-downs of inventory. These items are shown with the normal, recurring revenues and expenses, and the gain and loss. If mandatory, they will be disclosed separately before tax. Unusual or infrequently items are typically left in the primary analysis because they are related to operations. In supplementary analysis, unusual or infrequently items should be removed net after tax. Usually, an estimate of the tax effect will be necessary. A reasonable estimate of the tax effect can be made by using the unfettered income tax rate, usually disclosed in the note, or dividend income tax by the income before tax. Reference to the exhibit 4.4 with illusion and unusual or infantile item disclosed separately for the advanced micro device company. The unusual and so this is the periods of have the 2010 and 2009. This is a part of exhibit 4.4. Not all. I just obtained some things. It's illusion, the unusual and the infrequently items. Is again in the legally settlement in 2010 and 2009. So we can observe the red one. So this is one example for the unusual or infrequently item. The second special item of the income statement is the equity in earning of non-consolidated subsidiaries. When a firm accounts for the inventory in the stock using the equity method, the investment is not consolidated. The inventory report, the equity earning or loss, are the inventory's proportionate share of the investment earning. If the investor owns 20% of the stock of the inventory, for example, the inventory report income is about 100,000, then the inventory reported 20,000 on its income statement. In this book, the term equity earnings will be used unless equity losses are specifically intended. To the extent that equity earnings are not accompanied by cash dividends, the investor report earnings greater than the cash flow from the investment. If an investor company reports monetary equity earnings, its net income could could be much greater than its ability to pay dividends or cover monetary liabilities. For purpose of analysis, the equity in the net income of non-consolidated subsidiary resides in the particular problem. For example, the equity earning represent earning of other companies, not earning from the operations of the business. Those equity earnings can distort the reported result of business operations. For each ratio influenced by the equity earnings, this book suggests a recommended approach described when the ratio is introduced. The continued for the previous page because these earnings are from the non-consolidated subsidiary and inconsistencies can result between the numerators and the denominator when computing a ratio. Some ratios are distorted more than others by equity earnings. For example, the ratio that related income to sale can be distorted because the equity earnings. The numerators of the ratio include the earning of the operating company and the equity earning of the non-consolidated subsidiaries. The denominators sales, including only the sales of the operating company. The sales of the unconsolidated subsidiaries will not appear on the investor income statement because the subsidiary was not consolidated. This causes the ratio to be inconsistent. And we will talk about more about the detailed discussion of the ratio in the chapter 5. So, equity in earning of the non-consolidated subsidiary is the about equity in the earning will be presented before tax. Any tax will be related to the dividend received, and it will particularly be immortal. When removing equity earnings for the analysis, do not attempt to tax computations. Inconsistent is the we will show more about that. I know this is a little out of place, but I have to talk about the text first. Income tax related to operations. Federal, state, and local income tax based on the reported accounting profit are shown here. The income tax expensive including tax paid and tax deferred. Income tax reported there would not including tax on the item presented net of the tax. We will talk about here because it have all related to our others follow of the special income statement items like the discounting operations or extraordinary items, all about related about the tax. So we need to concede about the income tax here. This is the third special item is the discontinued operating. A common type of the unusual item in the disposal of the business or product line. If the disposal meets the critical of the discontinued operation, then a separate income statement category for the gain or loss from disposal of the segment of the business should be reported. Apart from the result of operations of the segment that has been sold, it is also reported in the conjunction with the gain or loss on disposal. This effect appeared as the separate category after continued operations. These continued operations pose a problem for a profitable analysis. Additionally, income from the continued operations would be the better figure to use to the project future income. Several practical problems associated with the remove of a gain and a loss from the discounted operations occur in the priority profitable analysis. This is a problem primarily involved 2 points. First point, an accurate disclosure of the data related to the discounted operations. The second point, they are lack of the past profit and loss data associated with the discounted operations. The best analysis will remove the income statement item that related to the discontinued operations. The best. But the income statement item that related to discontinued operation are always present net of applicable income tax. Therefore, the item as present on the income statement can be removed for the primary analysis without further adjustment for the income tax. Supplementary analysis consists discontinued operations in order to avoid dysregulate these items. Identically, the balance sheet accounting that related to the discontinued operations should be removed for the primary analysis, and considering these items on the supplemental basis because they would not contribute for the future operating revenue. However, inadequate disclosure often make it impossible to remove these items from your analysis. The balance sheet items related to discontinued operations are frequently disposed when the business or product line has been disposed prior to the year-end balance sheet date. In this case, the balance sheet accounting related to the discontinued operations do not present a problem for the current year.
Extraordinary items are material events and transactions distinguished by their unusual nature and by the infrequency of their occurrence. Examples include a major casualty, such as a fire, prohibition under a newly enacted law, or an expropriation. These items, net of their tax effects, must be shown separately. Some pronouncements have specified items that can be considered extraordinary. An example is a material tax loss carryover. The effect of an extraordinary item on earnings per share must also be shown separately. Exhibit 4 to 7 presents an extraordinary gain. In analysis of income for purposes of determining a trend, extraordinary items should be eliminated since the extraordinary item is not expected to recur. In supplementary analysis, these extraordinary items should be considered, as this approach avoids disregarding these items. Extraordinary items are always presented net of applicable income taxes. Therefore, the items as presented on the income statement are removed without further adjustment for income taxes.
Changing in accounting principle. At the time, this company will change from one generally accept as counting principle to another generalized accept as counting principle, or as counting principle is made absolute by a new standard from the FASB. Current GAAP require a retrospective approach to change in the S-counting principle, unless it's impracticable to do so. This means that previous year's financial statements that are presented are received in the year of change. Almost is the you can think about the balance sheet is present for 2 years, income statement for the 3 years, and the statement of cash flow for the 3 years. Right? The cumulative effect on the period years reported period through the change year is reflected in the company's beginning retail earning in the change year. With this stand, there is the comparable of the accounting principle for the statement presented. When using period annual reports, there will not be comparability. This does present a challenge when doing analysis. It will not be possible to do a consistent analysis if more than one annual report is used. When it is impracticable to determine the retrospective approach on the previous years, then it may be possible to determine the difference on the operating balance in the S-count. Then, the operating rental earning in the years of change will reflect the cumulative effect on the previous years. In this case, previous years' financial statements that are presented are not receivable in the years of change. Period to the current GAAP, voluntary changes in the accounting principle will present using the prospective method in the United States. With the prospective method, the accounting for each year, prior periods are not adjusted to reflect the effect of the applying the new principle. The new accounting principle is used in the current financial statement, and the effect of the using the new principle in the period financial statement is disclosed on the current income statement as cumulative effect to change in accounting principle net of tax. The United States reporting period prior to the new standard was inconsistent with the reporting under the International Financial Reporting Standard, IFRS. You can use this principle. If a firm considers subsidiaries to that wholly owned, the total revenue expensive of the subsidiary of include with the parent. However, to determine the income that would occur to the parent, it's necessary to deduct the portions of the income that would belong to the net income, non-controlling interest. Period to the December 31, 2009. This was called military shares of the earnings. This item should be present net of tax. Non-controlling interest reflects incomes from the ownership of the non-controlling shareholders in equity of the consolidated subsidiaries less than wholly owner. Exhibit 4.9 illustrate net income attributable to the non-controlling interest. Some ratios can be meritocratically distorted because of the net income non-controlling interest. For each ratio influenced by the net income non-controlling interest, this book suggests a recommended approach. So we finish about the special item in the income statement, and we will talk the new topic about the earning per share. In January, earning per share is the earning divided by the number of shares of our standing common stock. Chapter 9 presented earning per share in the detail and explaining is the computations. Meanwhile, use the formula of the net income divide to outstanding share of the common stock. Retired earnings as an account on the balance sheet represent the distribute earning of the corporation. A reconciliation of the retail earnings summarize the change in the retail earnings. It shows the retail earning at the beginning of the year, the net income for the year as an addition, the dividend as the subtraction, and conclude with end year the retail earning. Basically, you can give the formula here. So the retail earnings, the net income, and dividend. Finally, is end year retail earning. You can just list of that. It also included if the appropriate period adjustment net of tax, and some adjustment for change in accounting principle. This is restate beginning retained earnings. Other possible change to the retired earning are beyond the scope of this book. So we might talk about all, so we can just focus about the tax principles, the period adjustment somehow. Sometimes portions of the retired earning may be unavailable for dividend because it has been appropriated or restricted. Appropriated retired earning remaining part of the retired earning. The appropriations of the retired earnings may or may not have significance. Appropriations that result from the legal requirement, usually state law, and appropriations that result from the contractual agreement are partially significant. The the operations may leave unproportionately rented earning integrate to the pay dividends. Most appropriations result from the management decision. These are usually not significant because management can choose to remove the appropriation. And the note, corporations will not be able to pay a cash dividend even with an adequate unrestricted balance in the retired earning unless it has adequate cash or ability to the rising cash and has complete with the state law where it is incorporated. Caution should be existed not confuse rented earnings or appropriated rented earnings with cash or any other asset. There is no cash or any other asset in the retired earnings. The reason for an appropriation will be disclosed by the footnote either in the reconciliations of the retired earnings, or in the note. From this disclosure, try to arrive at openings on the significance, if any. The consolidations of the retired earning usually appreciates as the part of the statement of the stockholder equity. Sometimes it is combined with the income statement. If you observe the exhibit 410, they will give an example of the recognitions of the retired earnings begin present with a stockholder equity statement. And we move on the topic to the dividend, shares, and equity. The dividend and stock split. Dividend returned profit to the owner of the corporation. A cash dividend declared by the board of the directors reduced retired earning by the amount of the dividend and simultaneously created the current liabilities. Dividends payable. The date of the payment occurs after the date of the declaration. The dividend payment alias manages the liabilities and reflect a cash outflow. So we give a note that the date of the dividends payment, not the declaration, affects the retired earnings and created liability. The board of the directors may elect to declare and issue another type of dividend, termed stock dividend. The firm issue a percentage of outstanding stock as a new share to existing shareholders. If, for example, if the board declines the 10% stock dividend, and the owner holder the 1,000 share will receive it an additional 100 shares of the new stock. The accounting for the stock dividend, assuming a relatively small distribution, less than 25% of the existing stock, that's require remove the fair market value of the stock at the date of the declarations from the retired earning and transferring is that pay-in capital. With a military stock dividend, the accounting is different. Retired earning are transferred to the paying capital at the par value, or we call the state value, by the number of the additional shares. And we have a note that the overall effect of the stock dividend leaves total stockholders' equity and each owner's share of the stockholders' equity unchanged. However, the total number of the outstanding shares increases. A stock dividend should reduce the market value per share roughly in the same proportion as a percentage of the stock dividend. Total market value constantly or outstanding shares should not change. A more drastic device to change a market value per share is by declaring the stock split. A 2-for-1 split should reduce the market value per share to 1/2 of the value period to the split. The market value per share is the predicted may not change externally in the proportion to the split. The market value will result from the supply and the demand for the stock. Lowering the stock value is sometimes desired when the price is too high. implied as the percentage by management. Stock with high price are less redundantly traded. Either a stock dividend or the stock split can influence the demand and the trading of the stock. A stock split merely increase the number of the sharing of stock. It does not involve either retired earnings or paying capital. For example, if a firm had 1,000 shares of the common stock, a 2-for-1 split will result in 2,000 shares for the stock split. A par value per common share is changed in the uh, proportions to the split, and no change is made to retained earnings, additional paying capital, and the capital stock. For example, a firm with $10 per common stock that declared of the 2-for-1 stock split would reduce the par value to 5. Sometimes the company want to increase the market value of the individual share by declaring the reverse stock split. In this case, a company recall its present stock and issue a lesser number of shares. This could be 1-for-2, 1-for-3, 1-for-4, 1-for-5, da da da. The Semenya SI's corporation did a reverse stock split. You can find a state on the 170 page. Since a number of shares change under both stock dividend and the stock split, any ratio based on the number of shares must be restated for the meaningful comparison. For example, if the firm had the earning per share of the $4 in 2010, a 2-for-1 stock split in 2011 would require restatement of the earning per share to $2 in 2010 because of the increasing share. Restatement will be made for the all prior financial statements present within the current financial statement, including a 5 or 10 years summary. The legality of the distribution to shareholders is governed by the applicable state law. Currently, the 50 states may be classified into one of three groups for the purpose of the distribution to the stockholders. These groups are the following. There are almost three. Okay, first is the distribution to the stockholders are acceptable as long as the firm has the ability to pay debt as they come due in the normal course of business. Second, distributions are acceptable as long as a firm is solvent and the distribution does not exceed the fair value of the net asset. The third, distribution consists on the solvency and the balance sheet test of liquidity and risk. Those uh, upper the appropriateness of the distribution to the stockholders is legal interpretation. Uh, as accountants have not accept sorry as content have not accept the role of the disclosing the firm's cap, capacity to the make distribution to stockholders. Accounting have accept the rule of the disclosing the appropriations or the restrictions of retained earnings. Appropriations can temporarily limit the firm's ability to make distributions. These operations are the practical directed towards limiting or prohibiting the payment of the cash dividend. Comprehensive income was described in the SFAC number 6 as the change in the equity of the business enterprise during a period from the transactions and other events and the circumstances from the non-owner source. Chapter 1 describes the concept statement that several as the biases for the evaluating the existing standard of the financial accounting and reports. Concept statement 5 and 6, including the concept of the comprehensive income. Subsequently, SFAS number 113 was issued, required the reporting of the comprehensive income, but using the narrower definition than in the SFAC number 6 under SFAC number 130. Comprehensive income is the net income plus period's change in the accumulated other comprehensive income. So accumulated other comprehensive income is a category within the stockholders' equity, described in chapter 3. Comprehensive income, we have 4 points to discussion it. The first is about the foreign trade currency transaction adjustment. The expansions of the international business and the extensive current relation with the created special accounting problems. The biggest difficulty has been related to translating the foreign trade financial statement into the financial statement as the U.S. enterprise. U.S. financial reporting calls for the postponing the recognition of the unrealized exchange gain and loss until the foreign trade operation is substantially liquidated. This postponement and as accomplished by the creating a separate category within the stockholder equity to contain the unrealized exchange gain and loss. The net among the transaction gain and loss that otherwise with cost fluctuation in the earning from the transaction adjustment is not included in the net earning. Also, foreign currency transaction gains and losses are included in the net earnings. The second point is the unrealized holding gain and loss on the available for sale marketable security. Debt and equity security classified as available for sale security are carried at the fair value. Unrealized holding gain and loss are included in a separate category within stockholder equity until realized. Those the unrealized holding gain and loss are not included in net earnings. So we got a note here. That is the accounting only applies to security available for sale. Trading security are reporting at their fair value on the balance sheet date, and unrealized holding gain and losses are included in the income of the current period. Debt security paid to maturity are reporting that their amortization cost on the balance sheet today. The third point, changes to equity holder resulting from the additional minimized person liabilities adjustment. As accounting standard require the reduction in the stockholders' equity for the minimized person's liability under the defined benefit plan. As accounting for the defined benefit plan is reviewed in Chapter 7. So we just talk about that and then move on to the point 4 is the unrealized gain and loss from the derivatives instrument. Derivatives instrument are the financial instruments or other contract where right or obligations meet the definitions of the asset or liabilities. The gain or loss for some derivatives instrument is the reporting in the current earning. For other derivatives instrument, the gain and loss is reporting as components of the other comprehensive income. The gain or loss for this instrument is reorganized in a subsequent period in incomes as a hedging forecast transaction affect earnings. And we have some required disclosures needs to introduce. So it's as a required disclosure of following. First is the comprehensive income. Second, each category of the other comprehensive income. The third is the reclassification adjustments for the category of the other comprehensive income, tax effect, and the balance of each category. And that's not very more important, but you need to remember this part of the compares have the required disclosure. The S accounting standard provides considerable flexibility in the reporting comprehensive income. One format uses the single income statement to report net income and comprehensive income. The second format reports comprehensive income in a separate statement of the financial activity. The third format reports comprehensive income within the statement of the change in the shareholder equity. The FASB and the IASB entered into the joint project to improve the presentation of comprehensive income in a manner that as convergent as possible. At that time, the IFRS only provides for the comprehensive income to be presented either in a single statement or in a two consecutive statements. The result of this joint project is that FASB in 2011 issued an amendment as the FASB's accounting standard qualifications with ruling out of the option of the reporting comprehensive income within a statement of changing in the stockholder equity. Those with the effective financial years after December 15, 2011, only the following options are available. A single income statement reporting net income and comprehensive income, or reporting comprehensive income in a separate statement immediately follow the statement of income. This new standard is effective for the interim period. The converge of the comprehensive income is analysis in Chapter 12. IFRS and US GAAP for the income statement are similar with some presentation difference. USGAP requires either the single state or the multiple state form. There is no required format under IFRS. Under IFRS, expensive are classified their nature or function. Under IFRS, increment may be the revalued. This will result in the adjustment of the depreciation expenses, and the IFRS allowed for the alternative performance measure to be presented in the income statement that are not allowed by the USGAP. The model income statement in the Exhibit 420 aggregate the expenses according to their function. And if you watch the Exhibit 413, aggregate expenses according to their nature. This is the one is part of nature according to nature, one is according to the function. So please read the exhibit in the textbook on your own. Thank you. So we have now take a break today. Just move on to the summary and the key takeaways. The income statement summarizes the profit for specific periods of time. To understand and analyze the profitability, the readers must be familiar with the components of the incomes, as well as income statement items that require special disclosure. This chapter presents special income statements, such as the unusual or infrequently item, discussed separately. Equity in the earning of the non-consolidated subsidiary, uh, discontinued the operations, extraordinary items, and the net income non-controlled interest. This chapter also covered the reconciliations of the retired earnings, dividend and stock split, and comprehensive income. And finally, we cover the IFRS, International Consolidated Income Statement. So this is all important in this chapter. So we will move on to the next chapter. Thank you, everyone.